Now from hardware to software. Joining us now here in San Francisco is Kash Rangan, Goldman Sachs senior software analyst. His team putting out a note this week. Kash, good to have you here. Good to be back here in the Bay Area. So, fundamental question here. Is OpenAI becoming a single point of failure for the AI economy? People talk about it being a circular. I don't think it really is circular because they're taking money from a lot of places and putting money back out to a lot of different places. But is it becoming a single point of failure that hasn't yet proven its case?
Yeah, a point of failure for
the entire AI economy.
Yeah, it's certainly the case that there's a good case to be made for their funding and the merits of that funding. As to whether, I think the impact that I primarily focus on is what does it mean for software, the Microsoft and Oracles and Salesforce of the world, right? So there is certainly to be a case to be made that requires a lot of capital, and you're going to have to do it with debt because we've tapped out the ability of the hyperscalers' balance sheets to be able to fund the first round of building out these data centers. So I think the thing that I'm looking for is the enterprise adoption of AI. So consumers, certainly you've seen very good adoption, and that's one of the points we make in our collaborative report that Goldman Sachs put out on Monday across internet, semiconductors, and software, that you're starting to see the effect of this happen in the internet. Consumer-oriented end markets are starting to see that impact. But the thing that I've tried to focus on is the enterprise market. Where is the return on investment in the enterprise market? You've seen that happen in a narrow couple of silos. Coding, obviously everybody knows about Cursor, how AI is great at software development, et cetera. Outside of that, maybe customer support, the revenue picture across the tail of enterprise software segments is still a little feeble, and that is the thing that we're flagging in the report, that we're not yet at a point where we've hit the sweet spot in the stuff that matters to me and my clients.
Along those lines, we just saw Qualtrics doing this, $6.75 billion deal for another player in the experience software space. It's kind of playing in the same area as Adobe and Salesforce, seeing about a third of their customers, Zig Serafin, the CEO, telling me, really engaging with AI. So he seems to be investing in this area, which would seem to suggest he expects a payoff. Do you expect that kind of payoff?
Well, I'm not close to the details of Qualtrics, but let's say that if you're doing a big deal like this and you're seeing a lot of AI activity, everybody's seeing the AI activity. I think time will tell if the AI translates into recurring, sticky, repeatable revenue stream, because a lot of the AI activity today is revenue, but not annualized revenue. It's not recurring revenue. It's a high rate of churn. A lot of experimentation, pilot projects that are going on. And this is where I don't want to sound like I'm only bullish on the public companies. Clearly, a lot of private companies in the next several years are going to be fabulous stocks for our investors. But the one thing that people are discounting is that there is a fair amount of distribution and leverage and customer base and a maturity in what an Adobe or a Salesforce or a ServiceNow or Workday are going to put out. We've seen the early signs of some mature products that are coming out. And so those are the revenues that are held by contractual obligations that are really worthy of a multiple because they are profitable, repeating, contractually obligated, again, going back to that. So that's the stuff that we've not seen yet from the private company landscape.